We'll now be looking at other topics under profitability analysis. We got sustainable equity growth. Now, the sustainable growth ratio indicates the maximum earnings growth a firm can have without resorting to other means of financing. Highlight sustainable equity growth. So that's equal to the return on equity multiplied by 1 minus dividend payout ratio. So put a bracket, because 1 minus dividend payout ratio, that is equal to, right, percentage of earnings retained. So the key to sustainable growth is, underline, retaining sufficient earnings to reinvest in growth rather than paying out too much earnings as dividends. So for example, if the firm pays out dividends at the rate of 30% of earnings, it retains the other 70%. So the resulting increase in stockholders' equity will also earn a rate of return and can continue to generate the growth in earnings. But circle if and highlight, if a firm grows at a rate greater than its sustainable growth rate, in that case it will need additional capital from either debt or equity. We're looking at return on capital. So these are measures of a business's efficiency in using its asset to create profits. So here we're going to look at, highlight, return on investment or ROI. That's the degree of profit in relation to, underline, capital employed in the business. Highlight return on assets, ROA. So that's the degree of profits in relation to, underline, assets. Highlight return on equity or ROE. So that's the degree of profit in relation to, underline, equity. We'll be looking at profit margin percentages. Highlight gross profit margin percentage. So that's sales minus cost of sales divided by sales. So sales minus cost of sales, right, equals gross profit, and the denominator, circle sales. So the gross profit margin, that's gross profit divided by sales. Highlight operating profit margin percentage. So that's operating income divided by, circle, sales. Highlight net income percentage. So that's net income by, again, circle, sales. Highlight ROI. So that's return on investment. So that's equal to the net profit of the business unit divided by assets of the business unit. So for net profit, right, equals return. For assets, right, equals investment. So we are looking at ROI or return, that's the numerator, on investment, which is the denominator. Next, highlight ROA. So that's return on assets. Looking at the formula, so it says net income divided by average assets. So for the numerator, net income, that's right, equal to return. On the denominator, circle assets. So guys, we're looking at return, the numerator, on assets, the denominator. Now to calculate ROA, we often use the DuPont model. So looking at the model, highlight ROA, that's equal to, highlight, net profit margin multiplied by asset turnover ratio. So look at this, net profit margin, that's net income divided by sales. Asset turnover ratio, so we know turnover ratio means turn it over. So assets are going to be in the denominator and sales is there in the numerator. So asset turnover ratio, that's equal to sales divided by average assets. Now, when we multiply net profit margin by the asset turnover ratio, we have net income divided by sales multiplied by sales divided by average assets. So on that multiplication, if you scratch off sales in both the formulae, you're going to get net income divided by average assets. That's your ROA, or return on assets. To understand this further, let's look at an example that we have here. So you have Global Fireworks. Their financials show average total assets of $100 million, net income of $25 million, and sales of $250 million. So the ROA, underline that, that's equal to net income divided by average assets. So that's 25 million divided by 100 million. That's underline 25%. Now let's highlight ROA using the DuPont model, which is ROA equals highlight net profit margin multiplied by highlight asset turnover. So on this example, net profit margin, that's going to be net income divided by sales. So 25 divided by 250 million. So that's highlight 10%. Asset turnover, that's sales divided by average assets, or $250 million divided by $100 million gives us highlight 2.5. Now 10% multiplied by 2.5, that gives us highlight 25%. Now this is the same result that we got in our earlier calculations. So we can also use the DuPont model to calculate the return on assets. Remember, return on assets, that's equal to net profit margin multiplied by asset turnover ratio. Highlight ROE. So that's return on equity. So look at the formula. The numerator is net income, the denominator is average equity. So for the numerator, right, equals return. On the denominator, circle equity. So we're looking at return on equity. Now ROE, or return on equity, can also be calculated as highlight ROA multiplied by financial leverage ratio. So we know that ROA, return on assets, that's equal to net income by average assets. Financial leverage ratio, that's equal to assets divided by equity. Now when we multiply return on assets by the financial leverage ratio, you have net income divided by average assets multiplied by average assets by average equity. Now I want you to scratch off average assets on both the ratios. So that gives you ROE, which is net income divided by average equity. To understand this further, let's again look at the example on this page. So here we're looking at Global Fireworks with average total assets of $100 million, assets in stock, that's assets in equity, 45 million, assets in debt, so that's all the liabilities, 55 million, net income of 25 million, and sales 250 million. So underline ROE. So the return on equity is net income by average equity, or 25 million by 45 million, underline 55.56%. Alternatively, highlight ROE equals ROA multiplied by highlight financial leverage ratio. So ROA, that's net income divided by assets. So that's 25 million divided by 100 million gives you highlight 25%. Financial leverage ratio, so that's assets by equity, or 100 million divided by 45 million, highlight 2.22. So 25% into 2.22, that's equal to highlight 55.56%. Now this is the same result that we got in our previous calculation. on return on equity. So in accrual accounting that we use for GAAP, revenues are underlined recognized when they are highlight earned, circle and highlight realized or realizable. So the revenue recognition principle involves two factors. Number one, substantial performance of service. That means the revenue is earned. And number two, reasonable estimate of income. That means the revenue is either realized or realizable. So revenue is recorded when both these conditions are met, which is normally at the point of sale. Now moving down on this page, we are looking at highlight quality and stability of the revenue. So that's an important analysis, and we need to determine whether revenue that's of good quality and if it's stable. And here our considerations would include underlying elasticity of demand for products. So how flexible are the consumers? Would they reduce the quantity if the price increases? That's elastic. Or they will not be able to reduce quantity even if price increases. That's inelastic demand. Next, you got ability of the business to underline anticipate demand trends by the introduction of new products and services. Very important, underline level of competition. Next, you got degree of underline customer concentration and dependence on a single industry. You got degree of underline dependence of relatively few leading sales associates. So that's your sales channels. And lastly here you got degree of underlying geographical diversification of markets. So all these help in determining the quality and stability of revenues. Income measurement analysis. And here we have a few factors which need to be considered in income measurement. Underline estimates. So these are estimates regarding future events and their outcomes. Now these estimates are made by the management and are then verified by the auditors to determine if they are reasonable. Underline accounting methods which have an effect on the reported income. Underline levels of disclosure. So for disclosure, the more the better. Underline different needs of users. So you have different needs of the various users of the financials, which are the management, the investors, the creditors. Now this affects their analysis of the firm's financial statements. Now in this section on financial statement analysis, we're looking at a lot of ratios. But guys, there are several limitations of ratio analysis which need to be taken into consideration when you're analyzing ratios. So the first thing is that no single ratio or measure is capable of capturing all relevant or important information about a particular company. So the calculation of various ratios is underlined merely the starting point. Now ratios underlined mean nothing without some means of comparison, which may include past ratios of the same business. It could be a predetermined standard, or it could be comparison to other companies in the same industry. Next limitation is that for a ratio to make sense, underline there must be a relationship between the two accounts used in the ratio. For example, there's no relationship between shipping costs and marketable securities. Next limitation is that ratios require underline careful interpretation, because factors affecting the numerator may correlate with those affecting the denominator. For example, a firm could improve its ratio of operating expense to sales by reducing its cost of sales. But its reduction in sales costs, such as marketing, could also mean a loss of sales. Other limitations of ratio analysis are related to underlying seasonal fluctuations, or it could be underlined due to use of different accounting methods. So when you're using ratios, you need to remember these limitations of ratio analysis.